Welcome to another video weekly market commentary. And here with Alisha again. And what I really want to focus on today is kind of the short-term noise we're experiencing. It's very easy to get short-term pessimistic based on what's happening. And just to put that in perspective, Jackson Hole, Wyoming is hosting its annual Federal Reserve Presidents, right? And with Jerome Powell, the chair of the Federal Reserve, being there. And this notion of higher interest rates has really grasped short-term attention in the media for volatility right now. And it's very easy to get caught up in that. One of the things I wanted to talk about today is ways we can objectively think about the long term at this point. When I say long term, it could be as far as 6 months out, 12 months out, 18 months out. Usually when we reference the term long term, it's around that 12-month time frame for the most part, or maybe slightly longer. In one of the research pieces we're going to release with you, something we launched a couple of years ago, actually during the depths of COVID, is tracking 1, 3, and 5-year average returns of the markets post a 5, 10, 15, 20% decline. And what we see is overwhelmingly positive results over that long term, with the caveat that making rash decisions in the current environment often never yields those results. Because the reality is, you've all heard things like, and I'm sure you have as well, and ran the data, if you miss the best 10 days of the market over the past 30 years, your returns are notably lower. Mm-hmm. The reality is, a lot of those best 10 days come from the resurgence out of a bear market. It's that recovery component. So it is that staying in it for the long run and managing that cycle pays dividends, literally and figuratively in this case. And where I want to tie that is on a second research piece here, Alisha, that ties interest rates into nominal GDP. Okay, walk us a little bit on that relationship between that rising yield and what that means for overall GDP growth and on a nominal basis.
Sure. So what we looked at is we went back to 1960 and we went through to 2022. And what we see is that as GDP is increasing from the 60s to the peak in the 80s, interest rates are going higher as well. Then we had a period of declining interest rates in GDP. And now what we saw in 2020 was a burst of GDP.
Sure.
Now we are just going back to that trend. So we are seeing the Fed is increasing interest rates right now. That is going to happen over the next possibly a couple quarters into 2023 is what they're saying, but they are not going to keep them high forever. They are not going to keep increasing them forever. So this is really just trying to fight inflation. So we just need to keep that in mind as the markets are panicking from the Jackson Hole conference.
Yeah. And I think just to paraphrase that, right, the notion of raising rates by the Fed, kind of that act in itself, is not done just because they want to see the markets have some volatility. Right. There is a definitive and quantitative backdrop to it in that the economy is growing, and that relationship between rising yields and rising nominal GDP growth rates has persisted over time. Mm-hmm. And I know it's hard to grasp that now during the volatility, but the reality is that it's intact. Mm-hmm. And where that also actually pans out is on a third piece, which likely many of our clients have seen, and we're going to share it again, in tracking 10-year annualized returns of the market, right? The vast majority of investors do have a 10-year horizon. And as we extrapolate that forward, as we tie in the current GDP growth rates over the next 10 years, as we tie in our earnings expectations, as we look at all that objective data and the overall health of the consumer, 10-year annualized returns, that cyclical trend and that secular trend of that do remain in our favor over the long term. And we definitely want to focus on that because equity market participation relative to bonds continues to be something we favor tremendously, mm-hmm. and something we're going to continue to favor because objectively that tends to be the best potential for long-term best results of your financial plan.